Hey everyone, I just launched a new website, financeandliberty.com. Please follow the link in the description of this video and subscribe to our free newsletter, where you can keep up to date with all our original interviews, along with some of the best financial videos and articles from the web. You mentioned about the prospect of ending wars or the secession to war. Can you discuss a little bit about the possibility of this and expand on why you think this may be a possibility?
Yeah. Wars are a dead end on the economic trickle benefit. You hear some very wrong economic premises put forth that defense spending is good for the economy. No, it's not. What's the result? What's the final result at the bottom of the trail? It's a blown up bridge. It's killed civilians. It's a building that is all rubble. What's beneficial about that end product? Nothing. So you might have two levels of trickle down, but it's trickled down into an acid pit. That's not beneficial. I look at, say, a corporate product. Imagine something like a network device that's really, really clever and gets things done in a better way. What's the benefit? The benefit at the end of the road is you got people operating it, people hired to operate it, more efficiency, save money for the company, more budget available for hiring somebody or doing R&D research. That's a lot better than dead bodies, rubbled out buildings, and a destroyed bridge. The United States needs to wake up and learn that war economics is part of fascism and absolute destruction. Okay, that's my little preface. Trump promised to bring about détente with Russia, and he made some phone calls, and the Kremlin responded favorably in just the following week after the election. That was a month ago, and that was all very favorable. So I think what we're going to see is some progress toward resolution of these big problems like Ukraine. I'm already reading now that Ukraine's leaders are going to be orphaned. What that means is they're not going to get support from Washington. And I don't think they ever had support from Russia. That's all propaganda nonsense. They might still get some support from the other hidden player called Israel and the Mossad that was very critical in creating the Maidan coup, the Maidan uprising. Maidan is just the name of their square, like Wall Street is a street. I believe that Ukraine leaders are going to be left to die on the vine without the support from Washington. You're going to see a cutoff of the hidden U.S. Department of State funding that Victoria Nuland actually referenced, but not too many people in the United States paid attention to, including my own brother. He has no concept of what's going on behind Ukraine, and he's got a political science Phi Beta Kappa degree. Give me a break. I'm just a dumbass jackass who knows what's going on a lot better than the Phi Beta Kappa university-trained political science degree holder. Oh, my gosh. I think all of Southern and Eastern Europe are going to align with Russia and support the Gazprom pipeline initiatives. The construction will mean jobs. The pipeline flow will mean transit fees. And the actual supply of energy will mean industrial development. Their alternative is to align with the United States, block everything, bomb cities, and have more wonderful destruction. I don't think they're going to choose that route. I think Israel is in the process of aligning with Russia right now, and the main impetus behind that is the gigantic Leviathan energy deposit located off the Jordan, Israeli, and Lebanese coastlines. Israel is trying to get 100% rights to it by bombing their neighbors. Can you imagine you got a wonderful new lemonade stand in your neighborhood from a natural lemonade spring, and you throw grenades at your neighbors so they can't participate in the wonderful lemonade newsstand. That's regular policy with Israel. Okay, the Syrian war is much more difficult. Its war will be harder to end because it involves Langley with narcotics funding. It involves the Mossad in Israel with their narcotics funding. This is all stuff that the funding for ISIS was all raised a year ago, September, by Putin at a G8 meeting. Or, yeah, was it a year ago or was it last September? I think it was a year ago. ISIS was a PowerPoint presentation that Putin made at a G8 preliminary conference meeting where he showed all the funding coming from Langley, Mossad, through the Swiss banks in an elaborate network. Okay, and Putin's the bad guy, right? Uh-huh. Okay, so ISIS is supported by Gulf Arab money. I think Qatar has a big piece of that support. And notice that Clinton funds, $1.8 billion disappeared from the Clinton Foundation Fund, ended up in the Qatar Central Bank. So they're dirty. This narco money from Saudi Arabia, from the Bush family. Just a wonderful little cute aside. When the Bush crime family connection with Saudi Arabia was interrupted a year ago, the campaign funds for Jeb Bush went away. So he blamed his resignation from the campaign for president on all those criticisms of my mommy. Oh, yeah. How about cutting off all the narcotics money through your Saudi buddies who were involved in the cover story for 9/11? All right, so to end the Syrian war, the ISIS strongholds must be totally eradicated. And we're seeing that happen with the Russians and the Iranian army. There are actually quite a few Iranian soldier casualties. It's not much in the press. I'm hearing tens of thousands of casualties. So the war for Aleppo in Syria, in the west of Syria, might be the final hold of the Syrian war and the U.S. proxies. I mean, it is so disgusting. I could go on for half an hour about the ISIS soldier makeup, but they recruit from Saudi Arabia principally, but they also recruit from Eastern Europe and the Muslims there, like Chechens and that general area, but not exclusively Chechnya. Just, give them a job. Hey, I'm in need of a job. Oh, come on, fight the war in Syria. Have some fun. You'll be able to blow things up. You'll be able to rape some women. I'm not trying to be funny here. They're actually told you can rape women with impunity. And some Arab men really like that. Okay, so, in summary regarding the end of the war and its prospects, it's going to be curious to watch something that's going to be a little unnatural. The cabinet generals are going to be asked to reduce the war and reduce the related budgets and maybe to expose appropriation weapon fraud, while their cabinet members pointing fingers at their brothers in the Pentagon. This is not going to go over real well. So it's worth watching, as I say. Well, I tell you, every single element that we're discussing here is worth watching and very thorny, Elijah.
Definitely. And the next thing I'd like to discuss with you is a little bit about the U.S. Treasury bonds. And I think you mentioned this previously in the interview, how basically there's massive global dumping of U.S. Treasury bonds. And we've talked about this before, but I was wondering if you could discuss and give us an update on this.
Yeah. Well, the first thing to notice is that the Treasury bonds are seeing the interest rate, the bond yield on the 10-year. The 10-year is basically the flagship. You're seeing some dangerous movement to it. And this has been going on now since about June and July. It's moved from 1.4% last July to about 2.3, 2.4% now. It took a lot of people by surprise. I actually, in the most recent report for the hat trick letter, I came out with a chart for the TNX, it's called, the 10-year yield. And I point to a cup and handle reversal pattern that points to 3.1 in the next few months. It's 2.3, 2.4 now. Another 70 basis points are coming. This is sufficient. What we've seen already is sufficient to cause serious cracks. But if we move to 3% on the 10-year, we're not just going to see losses to the Fed's balance sheet. We're going to see some wreckage to the derivative complex, the derivative machinery that holds together the bonds, the whole bond market. Okay, we've got wider U.S. Treasury bonds yield spreads right now. Normally, that's a signal that we're going to have an economic recovery, but you can't think like that anymore unless you're a Wall Street high-paid, $500,000 a year analyst who's a corrupt idiot, moron, corrupt. You can't conclude the standard signals anymore. What it means is something behind the scenes is going on and changing to accommodate some big bondholders. And I'll tell you what I think it is. And this was a point raised by Euroraj, shared with me about 3 or 4 weeks ago. The Japanese are now the largest holder of Treasury bonds. Wasn't it just a little while ago that the Chinese were holding $1.5 trillion? Okay, well, they're now holding a little under $1 trillion, and the Japanese are holding a little over $1 trillion in U.S. Treasury bonds. So the Japanese, we do not, in Washington and Wall Street, which controls Washington, we do not want to see the Japanese dump Treasury bonds like the Chinese did and have been doing and are going to continue doing. We don't want to see the Japanese join them for a dual project Asian Treasury bond dumping extravaganza, because that would break the Treasury bonds, force derivative machinery explosions, and cause unbelievable problems that will never be resolved. In just the last 12 months, they follow something, LTM they call it, last 12 months. So it's a running sum of the last 12 months. We used to call them a moving sum, whose average was a moving average. Okay, if you look at the last 12 months, the moving sum of Treasury bond sales by foreign central banks and official entities, it's $375 billion. It's over $1/3 trillion. And each month, where you drop off the end month and you add on a new month, you get the last 12 months, it's getting worse. It was only $340 billion last 12 months from the previous month. Now it's getting worse. Okay, this is a trend that's well along. Now, why are nations selling their Treasury bonds? Now, you could just come up with a simplistic, wrong answer by saying, gee, I think they're just trying to make ends meet. Well, yeah, they've got deficits and they can't finance them, but they've also got lower energy income, oil and gas income. They got lower commodity income, like wood, like lumber, like copper, like iron. Chile's dealing with lower commodity income. So they're all dealing with lower income, and many of them are seeing dollar-denominated debts explode in their faces because their currencies are in decline. So they're selling Treasury bonds to manage all these problems that I've cited. This is very ugly stuff that does not have resolution. So they're covering deficits and enduring income declines. But we're told that financial institutions and investors around the world are buying up all this dumped Treasury supply. And that's wrong. That's a lie. It's an ugly lie, because they don't want to say foreign nations are dumping it, and the U.S. Fed and its other major central banks are soaking it all up by printing money, African and South American style. They don't want to say that. But in reality, it's the Fed the Euro Central Bank, the Bank of England, and the Bank of Japan soaking up the dumped supply. And how are we in the United States trying to encourage the Japanese to continue in this game? This is what Eurorush has exposed me to. We've promised the Japanese that they will have a 2% or more differential between their 10-year bond and our 10-year bond, and at the same time, we're going to make sure that their currency, the yen, does not rise versus the dollar. And I just checked. In the last few months, it's gone from 98 to 88. So it's lost 10 points, 10%. We have a 10% improvement on their carry trade. Okay, just from the currency standpoint. Oh boy, it's getting very, very complicated, and sometimes I get some things that are complicated. I don't get them exactly right, but they have to see a rise in the Treasury yield to compensate the Japanese and keep them happy. They're doing, I'm sure, a lot of different hedging on their currency and neutralizing that piece to it. But the Treasury bond, they're holding $1 trillion. They want some interest yield on that. It's called the carry trade. Okay. It's not from financial, private, and institutional demand. It's a lie. The rise is rather significant, 1.4 to 2.3. You know, think of a Sears Tower. And the fake Fed rate hike that we had last December, a year ago, that was not a rate hike. I mean, it was up 25 basis points, so we were told, but the effective Fed funds rate only went up 7, 8, 10, 12 basis points. It wasn't the rate hike. But the biggest change in there was the reverse repo, which forced the Wall Street banks to give up their cash to the Fed, there's your reverse, and therefore be able to leverage their treasuries to a much greater extent. So the Sears Tower, if you will, as a derivative entity, symbol, image, was 50 stories higher, and its base was, say, 30% smaller. Now you have the high winds coming from Canada with the lower oil price, and you have the high winds coming from the east in Wall Street with the higher bond yields. So this Sears Tower is more vulnerable since it's taller, more vulnerable since it has a smaller base, and it's enduring the shock waves from a lower energy price and a higher bond yield. So we got some tremendous stresses going on. If we get a move to 3.1% on the TNX to 10-year, I think we're going to see some openly evident and discussed and managed crisis elements having to do with the U.S. Treasury bonds. Incredible strain on the interest rate swap machinery, which produces the phony artificial demand for treasuries. There are almost no buyers, and there's $1.5 trillion per year in supply. These derivatives cannot endure the big movements in the structures. I think what we're leading to here is a formal discussion and planning of the U.S. government debt restructure. And I cannot imagine that would take place without the introduction of the new Scheist dollar. What better opportunity to offer a 30% haircut to the U.S. government debt to its owners than at the same time having a 30% cut to the new dollar, the Scheist dollar. The Fed funds futures contract right now is indicating over 90% likelihood, sometimes it's over 95% likelihood, of an official rate hike at the next FOMC meeting. We used to call that the Federal Open Mouth. Now it's called, officially it's the Open Market Committee, but Open Mouth Committee. Oh my gosh, if they do a rate hike, they're going to tell us that it's because of the stronger U.S. economy and a desire to return to normalcy. Well, there's no economic strength evident at all, And the return to normalcy is more like foreign requirements, rather, from the bondholders who say, we want a legitimate return on our bonds for U.S. government debt because, under 2% doesn't work anymore for us, and we'd really like to see closer to 3%. They want a return on their bond holdings to justify the risk from the U.S. deficits, U.S. economy, and U.S. wars. So it's going to be very interesting to see if we do get a rate hike. I think they might try it and then immediately say, no, we're not going to do that. Or at the last minute say we're not going to do that. Or 1 week later say we need to reverse that. I think they're going to cause some incredible problems. Okay, no such thing as a return to normalcy when you have QE for 5 straight years. No such thing. The final phase of U.S. industrial wreckage, I think, is upon us here, Elijah. It's from the rising currency, which is not stronger. The dollar has wrecked most other currencies. Therefore, the dollar, on a relative basis, is valued higher. Doesn't make it strong. Makes it less weak. Big difference. I still like mentioning the dollar is like 100 big balloons taped together with a nice big tail on the bottom. So you watch it rise, head up into the stratosphere, and it's going to burst from the lack of external pressure on the balloons. What's the external pressure on the dollar balloon here? I think it's trade payment requirements, trade payment allowances, trade payment practices. So we're in the final phase here. Now, I just noticed this a couple days ago, and the reading today is that the 30-year mortgage in the United States is up over 4.15%. It's up 66 basis points just since the end of October. So we're talking about 6 weeks. That's a lot. And we've been lied to about the U.S. housing market being in recovery. That's a bunch of crap. Any recovery that we had a year ago or 2 years ago was from private equity funds. And they've backed out because they cannot manage the properties. They cannot do it. They don't like it when the tenants destroy the kitchen and don't pay the rent and then leave. They don't like that. So the private equity backed out. That was the mini recovery that we had in housing. Raise the mortgage rates, I think you wrecked the housing market the rest of the way. So a lot is going on with the bond market, Elijah. And, the visible part is the rising TNX 10-year yield. The invisible part, the hidden part, is severe damage to the bank derivative machinery, the derivatives, the interest rate swaps. Severe damage to the interest rate swap machinery. And that's where demand is fabricated for soaking up supply. And it's done in hyperdrive. So I think we're going to see some accidents pretty soon in the bond market. You look closer to some of the internals like liquidity, and you do see accidents already happening. The bond market is the foundation for the dollar. And debt is its mass. We've never seen this before. We have a global currency reserve, the dollar, backed by $20 trillion of debt. Nations are in trouble in their financial structures if they don't have a sufficient amount of debt. Everything's upside down.
Now, you've talked about how we're being told there's, this great demand for U.S. Treasuries, but really there's this lack of demand. And also in the precious metal markets, we see gold and silver prices after the election falling, but you're saying there's actually a huge demand for gold and that we're seeing, or for physical gold, and that we're seeing a divergence of the gold price between the physical and paper markets. Can you talk about this?
What we're about to see is a big decline in all the paper markets. Paper stocks, paper bonds. We're seeing that right now in bonds. To see a rise in the yield for U.S. Treasuries is a death knell for the S&P. You cannot have a rise in the interest rates and see a rise in the stock market like we've seen in the last couple months. They're trying to prop up the stock market to prevent the American public from waking up. So you've got paper bonds hurting, paper stocks that are going in the wrong direction up. And at the same time, you've got paper oil, and that's not exactly doing well either, stuck at the $50 price level. I'm looking at the oil price this minute, and it's just under $50. Can't seem to get over $50. Well, what else is in this paper parade but paper gold? In the Chinese anniversary, I think it was early October, thereabout, don't pin me down, might have been late September, but right around that time frame, there was a Chinese anniversary of the birth of communist state, and they were not at their desks. And we saw several months of global mine supply sold in a few hours. Okay, this is what paper gold can do. They sell paper supply, drive the price down, and never deliver. The price suppression project that's ongoing for 20 years in the COMEX does not deliver in gold. I mean, they've actually got rules where you cannot demand your physical gold when you're holding a gold futures contract. Well, that's what it was originally for. Some jewelry companies or whatever industrial companies wanted their gold, so they would post some margin, buy a 3-month contract or a 6-month contract or whatever. And then when the time was up, they came up with their money to get their gold because they needed it. Whether it was a mint or industrial purpose or jewelry or whatever, not important. They needed their gold, and now they don't get it. There's no delivery of gold. In fact, if you make a big stink in the COMEX that you didn't get your gold from your contract, you're banned from future participation. All they're ending up doing now in the COMEX market is paper, cash, delivery equivalent, and you're invited to do it again for the next quarter. It's insane. All right. The paper gold market, I think, is going to go down with the paper stock market. We've already seen the paper gold mining stock market go to hell in a handbasket. I like not focusing on the COMEX. Some people send me a message and say, Jim, what do you think about the gold price? I say, define it. Because it's certainly not the COMEX price. There's no gold, physical gold in movement at that market. So what I like to do is focus on the difference between the COMEX price and the Shanghai price. And I've been told, and I check it myself once in a while, that it used to be like $8 and $10, $12 the difference, and now it's like $20, $30, $40, $50 difference. And you really don't get my attention until it's over $100. And then I've gotten a couple of reports from actual gold buyers. I've only got a few contacts. They're very hard to come by. I was told a couple of weeks ago, and I was told about a month ago, the same kind of stories that rhyme, but from different people. If you want to buy $100 million worth of gold, you've got to pay between $2,500 and $3,000 an ounce. Okay. Then I was told, if you want to buy some intermediate amount, like say $20 to $30 million worth, you cannot get it under $2,000 an ounce. You cannot get it. So where is the source for the gold coins that are out there sold at dealers and sold by the mint? I truly believe, and this is backed up by The Voice and a couple of people on my gang of colleagues, I truly believe that what we have is very expensive gold is made available to the dealers at the discount of the current price. I'm talking about half price. It's really $2,500, and the dealers get it for $1,300. And that way they have some supply for the unwashed masses who want to buy gold. They're smart for wanting to buy gold and capture this discount, but they're not smart in the respect that they don't know what the real price is. They just think, well, it's got to be more than this. I'm lucky to get what I get. Well, that's true. But the real price for a mid-level bin of gold bars, like 20 to 30, $40 million worth, is over $2,000 an ounce. I was just told $2,100 by one source. And if you want to buy $100 million, there's very tight supply, and it's right around the $3,000 mark, maybe a little bit less. Okay, so what's the gold price? I don't look to the COMEX to answer that question. That's what's going on. There's more demand now. Take a look at the Gold Eagle demand coming from U.S. Mint. The demand for the first, I think, 9 months exceeded the demand for all of last year, 2015. Why is the price going down? Because physical doesn't determine the price. It's the corrupt paper movement, and it's unlimited paper supply. So I don't pay attention to it. I mean, you got a lot of decent analysts out there who are looking, avidly and devotedly at the commitment of traders for the paper movement in gold contract. I couldn't care less. Why don't they instead try to contact Dubai, try to contact Hong Kong, try to contact other centers, maybe even Singapore, and find out what are people really paying for batches of gold, not a coin or 6 or 10. People are buying 50 bars. What are they paying? That's what I'm looking at. So, got to watch these premium prices, Eli. And, there's a big story right now in India, and I do not claim to be an expert or really well informed on what's going on in India, but I've been told by a couple of colleagues, and they said the same thing. There's a lot of counterfeit currency, so they eliminated the big bills in India. And a lot of counterfeit money is coming from Pakistan and funding terrorist events and weapons and explosives with their purchase. So the Indian government decided we need to cut back on the currencies. The big bills would stop this the most. If you don't stop the smaller bills, the people and their legitimate economy elements can continue. Okay, it's not that simple. They're trying to also eliminate black market movement of gold, and that often is using the big bills also. We've now have a dollar equivalent price in India for gold of $2,500. So what's the price of gold? I don't look at the COMEX to answer that question. I think the Western elite are trying to harm India with this confiscation and inhibited currency. The Western elite are trying to reduce the actual demand, the street demand, the institutional demand, the widespread demand in India of gold and jewelry, because it's so significant. In India, you've got somewhere around 17,000 tons of gold in their households. It's the elite and the middle class. The elite have a lot of it, and the middle class have some. Take a look at some of their weddings, and you see, like 2 kilograms of gold on the woman's dress and robe. It's loaded in her headdress, whatever, on her face, or on her neck, on her, like a little corona of gold. They're trying to harm India with confiscations. I heard stories in just the last couple of days that the Indian authorities are going into certain places like temples and households and taking the gold and, giving them their cash equivalent. But there's some kind of a movement to seize gold in India because all the official efforts, come forward and bring your gold and buy a certificate of deposit make your gold work for you, earn an interest, that sort of thing. That hasn't worked much in India because they suspect that those are Western bankers calling the rules. There's a lot more going on, but I'll tell you what I'll close with here, and that is something that really haven't seen much yet in evidence, and that is the gold trade note. I think we're going to see, I have now about 3 or 4 different stories of different companies that are turning down the Treasury bill as payment for trade at the ports. This is a growing movement. It's not just the United States. It's going to have a severe increase. An alarm bell come out when the Saudis announced that they will accept RMB, Chinese currency, for oil sales, and they really don't want as much Treasury bills. If they see that the Treasury bill is part of a bubble, they're going to want less of it for that reason too. But the gold trade note essentially will be posted gold as collateral toward a bond, a bill, bill payment, bond, for payment of delivery in a big shipment of something, whether it's oil or a container vessel or a big barge full of cement or lumber. The payments in Treasury bills are now not as popular as they used to be, and they're being blocked. I want to see this movement. I want to watch this movement closely because as it picks up a lot of momentum, we're going to hear about the birth of the gold trade note, and I think it's already in operation. And the voice told me that he has seen evidence of this already, and it's not yet widespread, but it is out there. It's just not big yet. And interesting times because that means there's going to be a requirement of a new dollar.
All right. Well, Jim, Willie, thank you so much for sharing your insights today. Before we let you go, did you want to share with the viewers where they can find you online and any last thoughts you had?
It's www.goldenjackass.com. We're past 12 and a half years now. This month is number, oh my gosh, I have it on my calendar. I didn't carry it over. This month is 153. Unbelievable. So a lot of months. There are two reports that come out every month. One is the Global Money War Report, the high-level battles, the de-dollarization, the wars to protect the dollar, all kinds of things, central bank policy to protect the dollar and keep things going. Okay, so there's the Money War Report, and the other one is the Golden Currency Report, which is a lot more ground level about the demand of gold, the mint demand, about movements within countries to shift toward greater gold and silver demand, and production problems of gold and silver in mine output, and that's where I also include the petrodollar, the oil world, because the oil world supports the dollar, and that has a lot of ground level activity and battle. I think we're going to see a big move coming in the next couple months, 3 months, 4 months, where OPEC nations, there are already 2 of them. It's Nigeria and Algeria. They accept Chinese currency for oil sales. So when you say that it's universal that the dollar is used for oil sales, that's not correct. Even within OPEC and their cartel, which means they're not really a cartel. They're not unified completely. They have their fringe element. Okay, so got the Global Money War Report, and you got the Golden Currency Report. They're issued every month. It's a labor of love. It's a lot of work, and I enjoy it immensely. I do miss my statistical analysis and marketing research, but this is more important marketing research. This is marketing research on the demise of the dollar and the transition from a very corrupt system that the world has never seen more deep corruption in support of, and movement toward the gold standard and its reinstallation. We're going to be lucky to avoid wider war as we see the dollar phase out and gold phase in, but I'm beginning to believe something that Cato passed on to me from his NSA sharp analyst crack crew, that we're very likely to move toward a dual universe where one universe is the dollar, Western Europe, England, Canada, maybe parts of Latin America. They're still connected to the dollar, whereas the Chinese RMB currency will become the standard for the other part of the world, the eastern part of the world. And theirs will be more legitimate as they migrate toward the gold standard behind the RMB, Chinese currency, and ours will get more and more corrupted with the dollar being printed by the trillions. I actually believe that when they tell us that there's $60 billion a month that's printed to cover the U.S. government deficit, I think they're wrong by a factor of 10. I think it's probably closer to $1 trillion a month. And that's what's going on. So that cannot continue. That cannot continue.
Once again, Jim Willie, thank you so much for your time.
Well, it's a pleasure being on. Thanks for having me. And I'm sure in a couple of months we'll have a lot more to talk about. And this storm it's reaching climax proportions. It's very interesting and full of intrigue. Thanks for having me on.
This video was brought to you in part by Reluctant Preppers. Click here to watch Reluctant Preppers' latest interview with Silver One's Greg Crow. In this interview, Greg Crow discusses what's going on with silver. For its numerous desirable qualities as investment asset, money, and unique industrial commodity, silver has been the favorite monetary metal throughout history. Why has silver recently fallen so far behind its richer cousin gold? Despite being mined at only 10 times the rate of gold, silver has fallen to 1/70th of gold's price, a ratio that is becoming increasingly unsustainable going forward. In the next leg of the current secular bull market, how much faster is silver likely to advance versus gold? Greg Crow, president and CEO of Silver One Resources, traces silver's historical roots and future direction, especially in light of major events that are combining to set a dramatic rush for silver in the months and years ahead.